Return on capital is your earnings before interest and tax divided by your working capital plus your fixed assets. Now, the three ingredients that go into this formula we've talked about in their own videos. So EBIT being earnings before interest and tax, working capital, which is your debtors plus your stock plus your work in progress minus your creditors, plus your fixed assets, all the tangible assets within your business. Why is this formula so important? It gives me a reference point for what is my return on all the tangible assets within the business. And we include working capital as a tangible asset because debtors and stock can be quickly converted to cash, and then using that to pay down our creditors, you'll end up with the tangible asset of cash. The fixed assets are the assets that we're deploying within the business. What do we want to aim for here? I believe if you're getting a return on capital within your business of 30% and above, you are doing a good job. And more importantly, as your asset base becomes higher and higher as your business grows, it's going to become more challenging to get that same level of efficiency and return. Now, in some businesses, like a service business, it might not be a very valuable insight. But if you're running a manufacturing, a merchant style business, a construction style business, these are very important metrics because you are going to have debtors, you are going to have stock, you are going to have work in progress. Naturally, you'll have creditors, but you'll also have fixed assets working within the business. If you're going 20% and below on your return on capital, that's where questions need to be asked. How do we influence this number? Well, firstly, EBIT being the key number, your profitability. Naturally, the more profit that we achieve while depressing the working capital and depressing the fixed assets we need on the business is clearly going to help us get a high return on capital as a number. Secondly, breaking down the factors of working capital as we touched on in that video. Minimizing your debtors, optimizing your stock, optimizing your creditors to get that value as low as you possibly can, but also keeping your fixed assets as low as possible as well to get the best return on capital in your business. Return on capital is a consistent benchmark for this reason. Looking at who the owner of the business is shouldn't change your return on capital to any great extent. What I mean by that is if the richest person in the world bought your business tomorrow, they would still have to contend with debtors, they would still have to contend with stock, they'd still have to contend with work in progress and manage creditors as well. Also, if you're running a manufacturing plant or a wholesale business and you have those fixed assets, you still need those fixed assets to run the business. So how rich or how debt reliant you are within your business, your return on capital shouldn't be inhibited by those factors. Quite clearly, the path to success: optimize your EBIT, minimize the working capital and the fixed assets.